I'd like to cover a topic we hear a lot about, interest rates, but specifically how interest rates move. See, it all starts with securitization. That's where we take a bunch of individual mortgage loans and put them together into a pool of mortgage loans. That pool is then converted into bonds, which are further subdivided based on risk classification, from AAA rated bonds, which are your lowest risk bonds, all the way down to unrated or junk bonds, which are those of highest risk. Now these bonds, or mortgage-backed securities, are traded every day just like stocks. And like stocks, mortgage-backed securities are very volatile, with their prices moving up and down during the day. Now, the price of these bonds and the mortgage rates that are tied to them move like a teeter-totter. When one goes up, the other goes down, and vice versa. To watch these price movements, we use charts that look like this one, called a Japanese candlestick chart. This chart shows the high, low, open, and close of any mortgage bond on any given day. We use these to predict price movements, and there's all kinds of patterns to look for. Rectangle patterns and inverted hammer patterns, stochastic crossovers. But we'll make it simple for you. Green is good and red is bad. When you see green, that's good. It means that bond prices are going up and mortgage rates are going down. When you see red, that means that mortgage bond prices are going down and interest rates are going up. A big point to make is this. Bond prices change, mortgage rates that are tied to them just follow those prices. So, what can we monitor in order to stay out in front of these changes? This leads to the big debate between loan officers and finance professionals, the difference between the 10-year Treasury and mortgage-backed securities. Information on the 10-year Treasury is readily available. It's in the front page of every newspaper in this country. But information on mortgage-backed securities is a little tougher to come by, and because of that, one is followed over the other. But there's a big difference between the two. In fact, three differences. The first of which is maturity, the second is risk, and then finally, correlation. What this all means is that if you have a loan officer who's watching the 10-year Treasury as a way to predict where mortgage rates are headed, they could be going in the opposite direction. In fact, we've seen many days where the 10-year Treasury moves in a completely opposite direction from mortgage-backed securities. So if you're watching the 10-year Treasury in order to gauge where rates are headed, you could be extraordinarily wrong. The point to all of this is that if you want to know what the share price is of one share of Microsoft, you don't watch Apple. You look at Microsoft. What we tell loan officers is to watch mortgage-backed securities, but also be aware of the 10-year Treasury and any other economic reports that are pertinent. We tell loan officers to have a 360-degree view of the market. And the reason we do that is because everything's competing for the same investment dollar. The price of stocks has an impact on bonds, which impacts mortgage rates. Even the price of gasoline or a jobs report or inflation has tons to do with where mortgage rates are headed. So it's really important to maintain this 360-degree view. Probably the biggest thing to avoid in all of this is the media, because the media is behind at best. This is a candlestick chart showing that CNN Money is behind the movements of the market. CNN Money released articles saying that rates are up and down, but after days of the market moving in the opposite direction. The point to all of this is that advice through the media can cost you money in terms of higher interest rates. To switch gears, let's look at what the Fed is doing to keep rates low, specifically the Fed's mortgage bond purchase program, and why the Fed is acting a lot like a diamond company. The Federal Reserve has promised to purchase $1.25 trillion of mortgage bonds through the first quarter of 2010. Through December, they're almost there, having purchased $1.07 trillion. Now, everybody knows that diamonds are expensive, but why? To answer that, let's go back to Econ 101. See, it's all about supply and demand. When supply is low, demand grows naturally, and with that, prices increase. So the diamond companies artificially keep diamond supply levels low to ensure high demand and high prices. The Fed is working in much the same way. They're purchasing mortgage bonds, keeping the supply of those bonds low, which artificially raises the price of those bonds. Back to our teeter-totter, when prices increase, rates decrease. So that's how it works. The question of will it work is a resounding yes. This purchase program is the reason why mortgage rates are currently so low. So the question then moves from will it work to how will it end? See, the Fed's program runs out after the first quarter of 2010. It's a safe bet that rates will rise after that point, which leaves loan officers in a bit of a pickle, and underwriting departments overloaded with people trying to get their low rates before the Fed stops their program after the first quarter. So what should you, the client, do? Well, meet with your loan officer today to schedule a consultation and beat that first quarter rush. Better to get a low rate now than to wait too long when rates are higher.